Hi, this is Miko, and this video is mainly for people that this is their first time financing or attempting to finance a car. I'll try to make it just to break down the simple terms and simple concepts that you can understand easily, and to give you quick and easy steps to make sure that you understand what you're doing, don't pay too much, and don't get yourself in trouble. That's basically it. So to start with, why do we even need this video? Because mainly first-time buyers these days know even less than they used to know. Reasons for that, personal finance in the internet age is just something that's lacking. Nobody teaches it in school, and people are more disconnected from their friends, their family. There's nobody to take you to a dealership and show you how it actually works. Another reason is COVID-19. A lot of us were separated and just basically alone for a couple of years, so that did not help. And the industry, unfortunately, there's not enough regulation, and there are a lot of predatory practices, not as much in banks, but mostly with car dealers. So let's get into it. What is a car loan? So first of all, it's just that you're borrowing money to buy something. There's a car that costs $20,000. You only have $5,000. You need a car. What do? Dealer connects you with a bank, or you find your own bank, and that bank loans you the money. You borrow that money, you give it to the dealer, you get the car, and you go on with your life. You can get to work, to school. Your car is the collateral. This is the important part. There are such things as personal loans, unsecured loans. Sometimes your bank or credit card will give you a loan without any collateral, meaning just like, we trust you, here's some money, do with it whatever you want, you're going to pay it back. Car loans are more secure. They're just like mortgages. When you get a mortgage, it's a loan where the house or the apartment is the collateral. Same with a car. And it's important that the collateral has to at least match or come close to, the value of the collateral has to come close to the amount that you're borrowing. So that's an important concept, and we'll get deeper into it. The interest, or what's called the APR, or the finance charge, it's all the same thing, is the profit. This is how the bank or the dealer or them together make money. This is why it makes sense for them to lend you the money. Also, it covers their risk, and also it covers the inflation, which is, important these days. That's why rates are so high, because inflation is high. So the dollar from three years ago cannot, you could buy, let's say, a hamburger for $1 3 years ago. These days you need $2. That's inflation. That dollar is not worth as much anymore in real value. And then finally, when you get a loan, your payment is just a very simple equation. You borrow $10,000, they add whatever the interest is. Let's say even without the interest, you take the $10,000. If you loan is 60 months, divide the $10,000 by 60, and that's your monthly payment. And that's also a really important concept that a lot of people just miss completely, because like dealers will mess with them, and their friends tell them, oh, this is what you should pay. But if you take a $30,000 car, you cannot be paying $300 a month for 60 months. Just the math is not going to work out. So that's an important part of it. Now, how much can you borrow? So for any given person, important things to know is the loan to value ratio. Loan to value means the value is the value of the car. Remember, the car is the collateral. If you want to borrow $10,000, the car has to be worth, again, very basically $10,000. If you stop paying, the bank's going to take the car back to cover the loan. They're going to sell it and take the money. That's how they protect themselves. So it has to be close to that. As you go with your loan, let's say a year or like halfway through the loan, right? So the car loses its value because of depreciation, but the loan is also smaller because you're paying off the loan as you go. So ideally, the loan to value ratio stays the same and the bank is protected. That's really important for them. Another thing that's really important is the sales tax and fees, whatever has to be added to the price of the car. So if you're borrowing, let's say you want to buy a $10,000 car, okay? The value of the car is 10,000, but if you don't have any money down, you might need to borrow 11,000. So now your loan to value ratio is too high, and you need a down payment, or maybe you need to find a cheaper car. But basically, it's an important part of it. The price is not all that's there. Remember, there's always taxes and fees. And the down payment, that's what helps with taxes and fees. That's what helps to bring the loan to value ratio to where the bank is comfortable in lending you money, giving you money for the car. Trade equity, that's if you do have a car to trade. We're talking about a first-time buyer, so probably not many people have cars to trade, but that's basically is treated as cash if you actually have equity, or if you have already a loan and you have negative equity. I'm not going to get it too deep into that, but that will affect your loan to value ratio as well. That's when people are upside down, what they call in the car business, which means that their loan to value is affected negatively by the fact that they owe too much money on the previous car. And lastly is the risk. So we'll talk more in details about the risk, but again, remember, the bank makes money on the interest, but they want to make sure that they get their money back. And the risk is that you will stop paying that money. Yeah, there's the car that they can get back. What if there's no car? What if they can find it? What if they cannot repossess it? The car is gone. And so there's definitely a risk that's involved, and that will limit how much you're going to borrow from the bank. So let's talk about the interest, which is the part of the loan. There's the what you're borrowing, that's the amount financed, but there will be added interest. So interest is, like we said, that's what gives the bank the profit. That's what lets the bank make the money and pay for the operations and pay the shareholders. It also covers the risk. So even though there's collateral, there's still a risk, which means like I said, maybe they just cannot find the car to repossess and you're gone, you're not paying your bills. So now the bank is out of the money that they let you, let's say the $10,000. So, but the bank is looking at the big picture. So if they issue 100 loans, if 5 of them are just gone, they want to make sure that the interest that they collect from all the loans cover that risk. It's just like insurance, pretty much. They look at the big picture, and that's how they collect the interest. What is APR? APR is annual percentage rate. I'm not going to get into that because it could get really deep, but basically that's another name for their interest. That's another name for your rate. Annual percentage rate is APR. It's in 2 words. It's on annual term, what's left of your loan, how much you have to pay interest on it. That's what APR is. It's more complicated because it's actually calculated monthly, not annually, but interest and APR is pretty much interchangeable for our purposes. What is finance charge? That's exactly the same thing, except that the finance charge is the actual amount which you will pay in interest over the whole term of the loan. So sometimes people get scared, especially first-time buyers, when they see on the contract, oh, there's finance charge. I'm paying 5% interest, but there's finance charge. It's not 2 things. It's the same thing. It's just expressed differently, just in one amount and disclosed for your convenience. How is interest calculated? So they look at a few things. First of all, they look at the risk. Remember, we talk about the risk. And like insurance agency, they look at just the probabilities. It's just statistics. It's a whole industry, a whole science. When they look at you as a person with where you are in life, and they decide what kind of risk do you represent. If you are established, you have a family, you have a mortgage, this is not your first loan, this is minimal risk, okay? No matter what happens, even if you die and the car gets totaled, you have insurance, the bank has virtually 0 risk. But if you're a first-time buyer, it's a different thing. I'm sure you're a fine gentleman or lady and a great citizen, and you're planning on paying your loan, but we don't know that for sure because there's no previous data that we can build on. How banks decide what the risk is, they look at your credit score or your credit history. And it's important that those are 2 different things. A lot of times new buyers have relatively high credit score, let's say 740, but they will be very low, very short history, just let's say one credit card for a year or two. And so that means even though your score is high, your risk is quite high as well. On the other end, there could be a person with established credit, but their ratio of how much money they make versus how much they already borrowed is affecting that score negatively. So the score could be 650, but they can still get a loan because bank can see that whatever I'm borrowing, I'm always going to pay that no matter what. The car. Okay, this is the important part to see how the interest is calculated. And remember, it's important for the loan to value ratio, the LTV, but it's also important for the interest because also that's a risk. Your car could just die completely. It could just fall apart and stop working, and the insurance is not going to pay off the bank. So if you just say, you know what, that car's gone, I'm not going to make those payments, I don't care. The bank has nothing to take back because it was an old car and it was more probable that it will break down. That's why the interest will be higher the older the car is. Markdown, markup. So this is kind of important. So markdown happens mostly with new cars or let's say certified pre-owned cars where the bank is connected to the manufacturer. Let's say Toyota sells you a new car. They have their own bank. Okay, it's an official FDIC insured bank with all the licenses and everything. And the manufacturer tells the bank, their own bank, listen, we really need to sell a lot of these cars. So even though the interest should be 3%, can you do something and make the interest lower? And the bank says, yeah, no problem. We're the same thing. We're the same corporation. We work together. How about I make it zero? I will just pay to whoever I get the money from. I take all the risk on my own and I pay for the risk and the loan will be free. And that's the markdown. Sometimes it'll be not just a manufacturer bank, but let's say Bank of America, which is a huge bank, but they want to sell mortgages, right? So if I'm an outstanding citizen and they can see that it's probable that I'm gonna buy a house soon, and now I apply for a car loan. So even though normally they would charge, let's say again, 3%, they really want my business. So they'll say, okay, for you, it'll be 1.5%. How about that? So that's markdown. Markup is the opposite, and almost always it's the dealer. Dealer is allowed to mark up the rates. Dealers are providing you some service. We're not going to get into the morals and ethics of it, but by law, dealer is allowed to mark up your rate up to 2.5%. So if on your behalf, dealer goes to the bank and says, okay, this couple wants to buy this car, they want to borrow $20,000. What's the best rate you can give it to me? The bank said, I'll give you 3%. The dealer says, great, Mr. and Mrs. Customer, your rate is 5%. This is what's on the contract. It's legally disclosed. If you agree, the dealer basically pockets the difference. They don't pocket the whole thing. They have to share it with the bank. It's a complicated relationship, but that's what happens. Not always dealer gonna mark it up. Sometimes dealer will say, you know what, fine, I want to sell the car. I don't care if I make money. A lot of times the bank will pay the dealer some kind of fee, even if they don't mark it up. So it's not, the rate is not always marked up, but it could be marked up. And what's kind of important, dealer has ways, dealer can provide you service. You can go on your own, and we'll talk about that. You can get your own loans, but let's say you went on your own and found 7%. Maybe dealer has a relationship with some bank that you never heard of that'll give 2%. Dealer is going to mark it up 2%, but you still saving money. So it's kind of like a win-win situation. All right, so what happens when you actually get the loan, buy the car, and get the loan? So this is the important things. Again, I don't want to get too deep into things like approvals and all of this. I'm giving you the most important things up front. So one of the most important things is when you finance a car, read the contract and understand what you're reading. I'm going to show you exactly what you need to read. Those contracts are very long. The actual retail installment or finance contract, they could be very long. I don't think you need to read the whole thing because a lot of it is small print. And small print is just it's on every contract. You cannot change it. Dealer's not going to change it. It is what it is. But what dealer can change and what you need to know is the first 2 pages. And I'll go in detail and talk about what it is. Okay, so first of all, don't sign what you understand, what you didn't read. If dealer wants you to sign some kind of agreement when you actually buy the car and just says, well, sign it right here, this is your payment. Okay, that's great. If this is the final contract when you're actually, after that, you have bought the car, you want to know, you want to see the first 2 pages, read through them and see what it says. So like I said, you don't need to read the whole thing, but the first 2 pages. First page is Truth in Lending Disclosure. That's the page that's going to show you a few simple things. And I should have, let's see, there we go. So that's the first page. That's the Truth in Lending Disclosure. What you see here is your annual percentage rate, APR. This is the interest. Okay, so this is the important number. You want it to be lower rather than higher. Finance charge, again, this is something that people get scared of. Don't be scared. It's just this interest. If you did not pay off the loan for the full term, this is how much you would have paid in interest. It's important to see this number so you'll understand how important it is to get lower rate and how it could be useful for you to pay off the loan sooner because then you're going to pay less of that. But that's the amount of finance charge. Amount financed, kind of important to know how much you pay in total. And total payments. Total payments is just the math. It's your payment multiplied by the term. And that's what it is. And then the last one is all your payments plus the down payment. And if there's a trade or rebates, that's included there as well. And this is the second page. This is the itemization. This is not important specifically for financing, but it is important to look through because this is where a lot of first-time buyers or just uneducated buyers get taken advantage of by dealers. Because if you don't read what's there, they can just sneak all kinds of things. And as long as you agree to payment, you don't even know what's included there. So for example, here there's a breakdown. There's a down payment of $500. So first of all, on top, there's the price of the car. That's the sale price. Then we have the down payment $500. There we have a rebate. That's the $500 from the manufacturer. So that's total down is $1,000. If there was a trade, equity would have been there as well. And then there's a breakdown. There are fees. There's the sales tax, and this is the important one, a little bit lower right here on the H section is all the add-ons. So add-ons, not going to get into the deep right now, but it's important that you know what's there. And this is something that, you know, it's basically on top. It's add-ons onto the price of the car that you thought you're going to pay. So why it's important? Well, it's complicated, but let's say in 2 words. Legally, you have to know that no matter what the dealer tells you, by law, you're not obligated to buy anything extra. Okay, that's one thing. 2 is no bank will lower your rate because you have bought warranty, service contract, gap, or anything like that. Okay, so legally, if dealer tells you, well, you know, you have to buy this, otherwise we cannot get you the loan, that's a lie. But dealer can tell you, we're not going to sell you this car unless you buy maintenance or you buy gap or buy something like this. They have the right to do that. They just cannot tie that to financing. And next thing it's important to understand, all of these things are cancelable legally. It's not going to be easy. Dealer is not going to make it, bad dealer especially, dealer that tries to sneak those things in, they're not going to make it easy for you to cancel, but legally, there are certain terms, you should be able to cancel it right away for full refund or later for some refund. But back to it, just read through this. Again, don't sign anything if you cannot read those 2 pages. First 2 pages, crucial. The rest, not as important. All right, other things you need to know. And again, these are just small things that, in my opinion, are more important than others. Credit check. So like we talked about credit score and credit history. Dealer or the bank cannot guarantee you what your rate will be until they check they pull your credit report. Maybe all 3 credit reports. There are 3 major agencies. For that, you need to fill up the credit application. You need to sign it. Okay, but you know, people know it's a common knowledge that checking your credit lowers the score, which is kind of like a weird quantum mechanics thing in that. But there's nowhere around it, so you have to do that. And also, good thing to know that if you're shopping for the car, all the credit checks within a certain period, like a couple of weeks basically, they're all counted as one check. So whether you check your credit once or 15 times within 2 weeks, the effect is the same on your credit. Cosigner. So if you're a new buyer, you have no credit history, the car is old and there's just no bank that can finance you, or they got your finance but the rate seems high, cosigner can help as long as the cosigner has a higher credit score or longer history or both. So just adding another person with horrible credit is not going to help. Pre-approval. This is a big one, and this is one thing that, you know, kind of like common knowledge for people that know, but people that don't know, it's important. Before you shop for a car, it's very useful and would be very advantageous for you to get pre-approved through some bank or credit union. How do you get pre-approval? Well, it gets a little complicated and could be, you know, it could take some time, but real pre-approval is where that bank or credit union checks your credit. They know which car you want to buy. That's another important part. Sometimes people will say, well, yeah, just go to your local credit union, check the rate that they offer. So I go to the credit union page and there's a big advertisement, rates as low as 2.9. I think, great, I'm going to the dealer, have pre-approval for 2.9. I don't. 2.9 could be on somebody with 800 credit score for a brand new car. My score is 640, I'm buying a 15-year-old car, my rate will be, instead of 2.9, it could be 18%, or maybe I cannot get approved at all. So real pre-approval, it has to be real pre-approval. And what it gives you is that when you go to the dealer and ask him, what's the best rate you can give me? They check your score, they tell you, well, great news, we got you 9%. Tell him, well, here's my bank, Bank of America or Chase or local credit union, they can give me 5%. Can you beat that? Can you match that? No? Okay, I'm gonna go to them. Now, one issue with that, especially when it's a seller's market, is that they can say, you know what, we don't care. You have to finance with us or you're not getting the car, and you cannot beat that. But that's unlikely, okay? Usually when you present yourself as an educated buyer and that you're ready for this, pre-approval definitely is gonna help you. Building credit. So prior to buying a car, it's good to build up your credit. How you can do that? Just get a credit card. Get a secured credit card, use it, pay it off. Sometimes you have to put a deposit. That's how you build it. Don't go crazy. Don't get a lot of them. Don't open accounts here and there, but that's how you build it prior. After the car, the purchase, that's actually a benefit, a side benefit of financing a car. It builds up your credit. When in a few years you decide you want to buy a house or a condo, and you go to apply for a mortgage, when they see that you have a car loan, that's the next best thing to a mortgage. That means you're solid, you're paying your bills, your score is high, so it helps you in the long term. Refinancing. So it's possible to refinance a car loan. And yeah, basically it's possible. You can always do that later. There's no guarantee that you will get lower rate because like we saw in the last couple of years, all total rates can go up. Average rate can like double. That's one thing. Another thing is that if you get a low rate that's been marked down by a manufacturer or a bank, it's unlikely that you're going to get a better rate later. Also, as your car that you already financed gets older, that means that the rates you will be offered could be lower, could be higher as well. So why it's important, sometimes you go to a dealer tells you, well, you're a new car buyer, best we can give you is this insane 22%. Well, we say, well, I'm not paying 22%. They'll tell you, well, don't worry about it. Just in a couple of months, refinance it. So yeah, you can refinance, but it's much better off to get pre-approved and get a decent loan right up front rather than trying to refinance later, which is not guaranteed. Spot delivery. Okay, this is a big one. I'm just going to touch on it really quickly here. Spot delivery means that in some states, dealer will look at your credit report. They will send it to the bank, but they will not get an immediate response. So they don't have a solid approval, but they will assume, okay, your credit history looks okay, your score is okay, So we probably can get you 4.9 through Bank of America. Here's the car, here's the keys, sign everything. That's it, you're gone or go home. That's a spot delivery, which means that, and there will be small print in the contract that'll specify that. What can happen is next day, the bank actually looks at your application and says, what? We're not going to get it approved. The car's too old. We don't like this car. We don't want this loan, okay, for whatever reason. Or they can say, oh, well, yeah, we'll approve them, but we need another $5,000. Or they say it's not going to be 5.9, it's going to be 10.9. So now the dealer has to scramble. They're going to send it to a different bank and say, okay, we have a contract for 4.9. Will you buy this? If that bank buys it, you're fine. Everything stays the same. But that bank can say, okay, we'll buy it, but everything, the whole structure has to be different. Different term, different down payment, different rate. Sometimes it actually can work to your advantage. Sometimes dealer in a hurry and they just get you a loan at 5.9. They don't get that loan, but then another bank will give you a better loan. So sometimes the loan will be better. Bottom line, if it's a spot delivery, there was no final approval, dealer will call you and say you need to come back and to re-sign the contract at different terms. Now, at this point, you have two choices. If those new terms make sense to you and you agree to them, you sign and keep the car. If they don't make sense to you, you don't agree to them for whatever reason, this is your option to tell them, you know what? No, here are the keys, the car's outside, give me my down payment, I'm done with you, okay? So that's a benefit of spot delivery. Also, that the main benefit is you can actually have the car and not wait, through the weekend, let's say. But this is spot delivery. And other things you might want to know. So how APR is calculated, meaning like how the monthly payment actually works. I'm not going to go deep into it, but if you Google amortization car loan calculator, you can see exactly how it works, how much of it goes to the interest, how much of it goes to the actual money with the principal that you borrowed, how to prepay or pay off. Usually car loans in United States are very easy, and I'm assuming in Canada probably even better. You can always pay it off. You can pay more towards the principal. The faster you pay, the less interest it'll cost you. What happens if you sell or trade the car? So if you sell the car, it's your responsibility to pay it off. Otherwise, the new buyer cannot get it registered. And if you trade it, dealer will pay it off for you. There's no way for you to trade the car and pay it off separately or keep paying. That's just not going to work. What happens if the car is gone? Usually we're talking about accident or theft. So all loans require full insurance, okay? So bank will require proof of insurance. Dealers are usually going to require it before they let you take the car. And that's what happened. Your insurance is going to pay it. There will be a deductible, which is your insurance collects. And also you could be in a situation where insurance does not pay off the whole amount. You still might come up with some money to cover the loan. Otherwise, you still have to pay it. Now, the bank at this point does not have the collateral, but they can go after you and just ruin your credit. So it's important that you pay it off. And you might want to Google what is gap protection, because that's related. Do you have to buy protection to get finance or get a better rate? I already touched on that, but again, it's really important. Legally, no bank will require you to get warranty or any kind of protection to give you a better term. And but the dealer might require it regardless of the loan. So that's just basically it. And this is it. Thanks for watching. I hope that it was helpful. If you have other questions, we run a forum on Reddit. If you search Ask Car Sales on Reddit, we try to answer all questions. Nobody makes money on it. Solicitation is prohibited. Nobody puts commercials. We just try to give you advice as best as we can. Thanks for watching.